Let's look at the tape right now. Across retail investing forums, financial TikTok, and brokerage leaderboards, attention is overwhelmingly hyper-fixated on high-beta artificial intelligence darlings, speculative biotech breakthroughs, and crypto-adjacent tech momentum. Meanwhile, traditional regional banking equities often get painted with a broad, lazy brush, dismissed by the mainstream media as archaic institutions vulnerable to commercial real estate cracks and interest rate margin compression. Yet, beneath this surface-level retail narrative lies a completely different operational reality: elite mid-cap financial powerhouses possessing structural moats, specialized high-margin verticals, and massive corporate transformation catalysts that completely defy old-school banking stereotypes. Consider Webster Financial Corporation, traded under the ticker WBS. For the uninitiated, the company looks like just another regional lender headquartered out of Stamford, Connecticut, managing a footprint across the Northeast. But looking at Webster purely through the lens of traditional brick-and-mortar retail lending is the exact kind of cognitive blind spot that separates institutional smart money from the retail crowd chasing short-term momentum. The real structural physics of modern regional banking value creation aren't found in teller lines or standard residential mortgages. They are anchored in specialized deposit engines, highly efficient healthcare financial ecosystems, and scale-driven mergers that alter the competitive dynamics of entire metropolitan corridors. When Banco Santander officially finalized its landmark acquisition of Webster Financial Corporation at a valuation of $75 per share, structured as a mix of cash and stock totaling roughly $12.2 billion, it sent a seismic shockwave through the financial services landscape that caught consensus retail media flat-footed. While casual market participants were busy arguing over daily Federal Reserve rate cut projections, institutional heavyweights had already recognized the deep structural value embedded in Webster's balance sheet. They saw an institution that had successfully digested massive transformative moves, including its landmark multi-billion-dollar combination with Sterling National Bank and the strategic integration of Ametros Financial into its specialized HSA Bank ecosystem. Retail investors often misread these complex banking transformations because they fail to understand the underlying data velocity and capital efficiency driving modern commercial finance. They see headlines about bank M&A activity and assume it is just legacy institutions shuffling paper. In reality, the strategic mechanics behind Webster's asset growth, scaling past $75 billion in total assets while maintaining a fortress balance sheet, created a prime acquisition target for global banking giants looking to dramatically expand their U.S. footprint. The market mispricing occurred because retail algorithmic sentiment and short-term financial media commentary were entirely anchored to macro jitters, completely missing the idiosyncratic value of Webster's diversified revenue streams, elite deposit franchises, and structural positioning as a premier commercial banking powerhouse in the affluent Northeast corridor.